What are respondents to CNBC's latest Fed survey saying about the outlook for the economy? Our Steve Liesman has the results. Steve.
Jonathan, thank you. Two clear messages from the CNBC Fed survey. First, it's going to take a long time for the economy to get back, maybe as much as 1 or 2 years, and maybe longer than markets are now figuring. Second, it will take trillions more to get back to the economy that we had before from Congress and from the Federal Reserve. First, take a look at the unemployment rate forecast among the 36 respondents. 4.4% is the unemployment rate now. It's seen going up to 19% and hitting a peak in August 2020. So it's going to elevated unemployment will be with us for a while. Goes back down to just 11% by year end and 7% a year from this December in 2021. How much more money will it take? Well, at least $3.5 trillion more from the Federal Reserve. Its balance sheet is already up by $2 or $3 trillion, depending upon where and how you count it. And Congress, another $2 trillion. They've already spent $2.8 trillion. We asked our respondents to grade the different financial leaders in this crisis. Jay Powell is getting an A-. They mostly agree with his policies, except for the one where the Fed's buying high yield. Steve Mnuchin gets a B+. John Williams, who's running all this stuff, gets a B. But Donald Trump gets a C-, D+. And that is surprising from a group that typically has put their economic approval of the president at 60%. It's now down to 40%, the lowest in our survey, as well as a decline in his expected chances of re-election. So 3 of the 4 doing well. One of them, the big boss, not doing as well. Jonathan?
Stephen, I got a question for you then about the implications, you think, of some of this. That's a lot of spending. And at a stage like this where we're talking about the economy and keeping it from going into a tailspin, everybody's saying don't worry about it. But eventually, I imagine there are implications to all these trillions of dollars in spending. How do you expect future Fed surveys to take that into account? What will the questions be?
Right now, we're already asking those questions. And had I known you were asking, I would have looked it up, Jonathan. But I can tell you there is not a lot of concern right now about the deficit or the inflationary implications of it. It is something that I believe, okay, how concerned are you about the impact that higher budget deficits will have on the economy? 14% not at all concerned, 29% very concerned, 57% somewhat concerned. Jonathan, we're going to have these big deficits for a long time. And as long as interest rates remain low, I don't think there's going to be a whole lot of concern. And as long as inflation remains low, the issue of inflation is a topic for another day. But there's a lot of different views on whether the ultimate impact of all this is inflationary or deflationary.
I love hearing you call him Jonathan, Steve. It makes me smile. But in terms of this 2-day Fed meeting that is under... I call him John Fort. But but anyway, this 2-day Fed meeting that's underway right now, there seems to be an expectation in the market that we're not going to get any more major announcements, but maybe perhaps more clarity on how all of these programs and how all of these efforts by the Fed have been playing out so far. Is that what you're expecting, or do you think that there's room for some surprise here?
Well, I don't think so. I mean, it's interesting. All of the action at the Federal Reserve is outside of the meetings, essentially. The next big shoe we're waiting to drop is the Main Street Lending Facility. This is going to be a $600 billion program. It's a real lending program, not like PPP, which is essentially a grant disguised as a loan. So the Fed, I understand, is working very hard. It's been criticized. 2,000 comments on this program that it received. It's trying to distill right now. So that'll be the next shoe. Yesterday, we reported that they expanded the municipal lending facility. So the trillions that I'm talking about are the trillions that are expected by respondents from the Fed. The only other place it could come from, and we'll be listening for tomorrow, is the possibility of additional quantitative easing.